Hello, and welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with HoyleCohen Wealth Management. 2024 got off to a great start. Economic growth for the year looks to be decent, probably a little bit below 2023 standards, but a good year nonetheless. Employment is great. Job creation and job absorption numbers remain healthy. Consumer spending, great as well. Driven by real wage gains, consumers continue to drive the U.S. economy forward. Now, we could have a bit of disinflationary pressures wash up on our shores from China as overproduction and their own internal disinflationary pressures get exported to their trading partners. A little bit of that might be okay, because in the U.S., service sector inflation remains hot. And with the service sector being a greater percentage of the economy than the goods sector, that has created a few speed bumps on the path towards lower overall inflation. Now, a lot can happen between now and the end of the year, but all else being equal, we remain on the low side for inflation forecasts for the year and on the high side for economic growth. And speaking of growth, the expectation is for about a 2% annualized growth rate for the first quarter of 2024, and a continuation of that level at 2% for the full year, within a range, as put out by the Blue Chip Economic Forecast, of between 1% and 3%. The underlying strength of the U.S. employed consumer remains high, and it's the direction of their spending and investment that is driving growth and inflationary pressures. Productivity, we've talked about this before in these sessions. Productivity growth continues, and it's that growth that allows companies to offset rising wages and to maintain margins, profit growth, and valuation levels. Human capital right-sizing and applied technological improvements will be key to producing the earnings growth that's forecasted for the next 2 years. CEOs, their view of their own companies and the economy remains high, getting back to more average levels, and confident CEOs tend to invest in property, plant, and equipment, which is a good thing, because that will go in and continue to drive productivity forward. What are the risks? There's always a lot of risks out there, but one of the risks that's talked about often is consumer debt. Yes, consumer debt is rising. However, the debt service levels on that consumer debt remains around a 40-year average. Consumer debt is a component of household debt. Household debt is anchored by mortgage debt. And with that anchor of fixed rate, many of them at very low interest rates, the debt service levels on household debt remain in about the bottom 20% of reported data over the last 15, 20, 30 years. Not a bad level to be at. The next debt that's important or is talked about out there is federal debt. Yes, it's high. And yes, it was rising. It's backed off its recent high, but it's the debt service as a percent of GDP, which is the critical factor to watch with the federal debt. It has been rising. It is approaching 1990 highs. But the reason it's rising is when the Fed increased Federal Reserve rate, it took with it Treasury bill rates. With the U.S. government financing most of their borrowings with short-term debt, the result is they have higher debt service payments on their borrowed funds. When the Fed reduces rates, expect the debt service levels to creep back down. It won't be an overnight affair, but if the interest rates are at their peak and if we're going to have lower interest rates, expect that number to drop over time. Between the beginning of the year and just recently, the expected path of the federal funds rate has not changed, but the depth of the cuts has. At the beginning of the year, the expectations were that the Fed would lower the Fed funds rate to about 3% by mid-2025. That number is now at about 3.5%. So start to do the math on, we're right now at 5.25 to 5.5. A reduction to 3.5-ish is going to take those short-term rates down quite a bit. Stock valuations. Now, Stock valuations aren't cheap. We've had a great run on the market, so valuations are a bit high. And this is why the productivity growth, the revenue growth is so important to stock valuations. The expectations in 2024 and 2025 are for 11 and 13.5% gains in earnings per share, respectively, for those 2 years. Those two numbers alone would bring the PE ratio down to more reasonable levels, but it's achieving the earnings growth estimates, which are important to support both current PE levels and then company-specific PE expansion as the market begins to broaden. One of the things that you're going to see that I think is a sea change from what we've seen the last year has been the shape of the yield curve. Now, we've gone through a period where rates were very, very low, and then they rose, and then the short end of the curve, the federal funds rate, the treasury rates, savings rates, CD rates, et cetera, have all risen to fairly high levels. In fact, short-term rates are higher than long-term rates. It's called an inverted yield curve. As the Fed lowers rates, expect the short end of the yield curve to fall, meaning short-term rates falling below long-term rates. And it's about the time that those rates start to even out and drop that will start to chase more people out on the yield curve, we say, seeking longer maturities to lock in higher rates of income. One could do that now, but there's a little timing difference in terms of what can I make for the next 3 weeks versus what can I make for the next 3 years. I think that's the decision that is in front of investors right now, is when to lock in longer term rates. Well, we've covered a lot of material. I thank you for tuning in, and we'll talk to you at the next edition. Thank you.